Imagine this: a multinational corporation is set to acquire a promising overseas company to expand its global footprint. The deal looks perfect until a tax dispute in the company's financial history surfaces, threatens to derail the deal. In the world of cross-border mergers and acquisitions, navigating complex tax laws can mean the difference between success and failure. But with a right strategies and expert guidance, you can avoid costly mistakes and uncover hidden opportunities. In today's video, we will explain the critical role of tax due diligence in identifying risk and liabilities, how to structure deals to maximize tax efficiency, and why post-merger tax strategies are the secret to long-term profitability. Hi, my name is Olatunji. I am the founder and CEO of Taxmobile.Online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Tax due diligence is the first and most crucial step in any cross-border mergers and acquisition transaction. It involves a thorough review of the target company's tax position to identify potential risks and liabilities that would impact the transaction's value or future profitability. Due diligence allows the buyer to make informed decisions about the acquisition price, structure, and post-merger integration strategies. Key elements of tax due diligence in cross-border mergers and acquisition include identification of tax liabilities. This involves reviewing the company's past tax filings and payments to uncover outstanding tax liabilities such as unpaid taxes, underreported income, unclaimed deductions, or anything that could trigger audits. Assessment of tax disputes and contingencies. This involves checking for the history of audits, ongoing disputes with tax authorities, and potential tax contingencies. Advisors analyze the likelihood of adverse outcomes and quantify potential exposures to provide a clear picture of the risk. Transfer pricing compliance. Advisors evaluate whether the company has complied with transfer pricing regulations by reviewing transfer pricing documentation, analyzing intercompany transactions, and identifying potential risks of adjustments or penalties. Deferred tax assets and liabilities. Deferred tax assets and deferred tax liabilities arise from temporary differences between book and tax accounting. Due diligence involves evaluating these items to understand their impact on future tax obligations and post-acquisition balance sheet. Deferred tax assets, such as net operating losses, can be valuable assets if they are transferable, but deferred tax liabilities would represent future liabilities. Analysis of tax credits and incentives. Tax advisors examine tax credits, incentives, or reliefs that the company may have that could benefit the buyer post-acquisition. They determine their validity, duration, and transferability to the acquiring entity, as they can significantly affect the financial valuation of the target company. Transaction structuring. Another critical decision in a cross-border merger and acquisition deal is whether to structure it as an asset purchase or a share purchase. Each option comes with unique tax and legal implications that can impact the buyer's and seller's tax liabilities, cost basis, and exposure to potential liabilities. Let us break it down. Asset purchase. In this structure, the buyer acquires specific assets and liabilities of the target company rather than its shares, allowing them to avoid certain liabilities of the target. This allows the buyer to step up the tax basis of the acquired assets to their fair market value, which can provide valuable tax benefits through higher depreciation or amortization deductions. However, asset purchases may trigger VAT or other transaction taxes in some jurisdictions and could complicate the transfer of contracts and licenses. Share purchase. In this structure, the buyer acquires the shares of the target company and takes control of the entire entity, including all its assets, liabilities, and legal obligations. A share purchase is often simpler from a legal perspective as the business continues to operate without the need to transfer individual assets or contracts. However, the buyer inherits all historical liabilities, including tax exposures, and does not receive a step up in asset basis for tax purposes. Additionally, sellers might face capital gain taxes, which may influence negotiation. Tax advisors help weigh the financial and tax implication of each option, balancing factors like liability risk, potential deduction, and transaction taxes. Advisors also explore hybrid structures, such as purchasing shares through a holding company to balance tax efficiency and risk management. Post-merger integration and optimization. Post-merger integration is a critical phase where the acquirer seeks to align the target's operations and tax structures with its own for maximum efficiency. Effective integration helps streamline compliance, optimize tax positions, and realize synergies between the entities. The key areas of focus in post-merger integration include harmonization of tax reporting and compliance. Tax advisors assist in consolidating tax reporting processes, ensuring that the combined entity adheres to all local and international tax obligations. This may involve standardizing accounting methods, aligning tax filing timelines, and consolidating transfer pricing policies across jurisdictions to streamline compliance and minimize risk. Optimization of intercompany transactions. After a merger, intercompany transactions like loans, royalties, and service fees often increases. Advisor helps structure these transactions to ensure they are conducted at arm's length, aligned with transfer pricing regulations, and optimizing tax benefits across jurisdictions. For example, interest on intercompany loans can be structured to benefit from favorable withholding tax rates or tax deductions in high tax jurisdictions. Use of tax attributes and losses. If the target company has accumulated tax attributes such as net operating losses or tax credits, advisors determine whether the acquirer can utilize these to offset taxable income or future tax obligations. Some jurisdictions restrict the use of losses after a change of ownership, so advisors analyze the applicability of any restrictions and develop strategies to maximize the use of these tax assets. Entity rationalization and legal structuring. After the acquisition, redundant subsidiaries or entities may exist. Advisor evaluates whether to merge, dissolve, or restructure them to simplify the corporate structure, cut costs, and improve tax efficiency. Rationalization also reduces issues of compliance risk by eliminating entities and may otherwise require tax filing in multiple jurisdictions. Exit strategies. For long-term mergers and acquisition planning, it is important to have a well-thought-out exit strategy. It helps companies structure their investments and operations to maximize after-tax returns, mitigate liabilities, and ensure seamless transition when it is time to sell or restructure investments. Key techniques for planning exit strategies include treaty shopping. Treaty shopping involves structuring investments in a way that allows the business to benefit from favorable tax treaties. For example, by establishing holding companies in jurisdictions with favorable double tax treaties, businesses can reduce withholding tax rates on dividends, interest, and royalties when repatriating profits. Advisors help identify suitable jurisdictions and ensure that treaty benefits are accessible and compliant with anti-abuse regulations. Offshore structuring. By locating holding companies in low-tax jurisdictions, businesses can defer or reduce taxes on foreign earnings until profits are repatriated. Advisors assist in establishing these structures in compliance with anti-avoidance laws such as the Controlled Foreign Corporation (CFC) rules in many jurisdictions, which aim to prevent tax deferral through offshore entities. Capital gains planning. In cases where a business intends to divest or restructure, capital gain tax can significantly impact the proceeds. Advisors develop strategies to minimize capital gain taxes, such as optimizing the timing of the sale, leveraging capital losses to offset gains, or using legal structures that qualify for capital gains exemptions. For example, some jurisdictions offer capital gains tax relief if assets are held for a certain period or if certain types of assets are sold. Repatriation strategies. When repatriating funds from foreign subsidiaries, businesses face potential tax implications, including withholding taxes and corporate income tax upon remittance. Advisors develop repatriation strategies to manage these taxes effectively, often through methods such as dividend planning, loan repayments, or royalties to achieve a tax-efficient outcome. There you have it. In conclusion, through effective tax due diligence, strategic transaction structuring, and post-merger optimization, tax advisors enable businesses to maximize value in cross-border merger and acquisition transactions while managing risk and tax obligations. Additionally, careful planning for exit strategies enhances long-term flexibility and allows businesses to achieve optimal tax efficiency when exiting or restructuring investments. With each step requiring a sophisticated understanding of tax laws across multiple jurisdictions, tax advisors are essential to navigating the complexity of cross-border transactions. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.